Hey everybody, quick snapshot video on linking SRAC curves to the LRAC curves. And I know this causes a lot of confusion generally, but we're trying to keep it really simple here. It's advisable to watch the video on SRAC first, but if you haven't done so, it should still be okay. We want to first understand that the short run average cost curve of production, which is the U-shaped curve that we're quite used to, so something like that, okay, is drawn like that. For specific reasons. Again, they're recapped in their previous video of mine. However, for now, we want to know that because it is a short run curve, we understand that there is one fixed factor of production. Generally, that factor of production that's fixed is either land or capital. Okay, in most textbooks, they will say capital is the fixed factor. So this business isn't able to change land or capital in the short run. And that causes issue, of course, which we've discussed before in previous videos. But one of those issues are, for example, diminishing marginal returns. Now, in terms of linking the SRAC to the LRAC, well, when there is one fixed factor for a business, you have to remember that fixed factor, whether it's land or capital, okay, factories or machinery, for example, depending on the scale of production, firms may not change, but initially have different ideas of how they adjust the volume of capital or land that they have. For example, this SRAC that I've drawn, we could argue that it's drawn slightly differently. And if we just highlight, for example, how it's drawn, we could say that SRAC1, okay, might be here. The short run average cost curve might be up here. So at this SRAC might represent a corresponding level of capital. Yes, capital is fixed, but let's say that this firm has one piece of machinery here, and that's what they chose to start with. However, it is also possible that the firm may decide to start with two pieces of capital, or have a bigger land, for example, or a larger factory. And if that's the case, then their SRAC curve would be lower down, okay? And it would look something like that, SRAC2. And then the same thing, what about three pieces of machine that the firm starts with? So it's fixed, it remains fixed, but they initially bought three, or they have, again, a larger factory that they're working from compared to the previous two scales of production. So you see the point here. What we're saying is that each level of SRAC, this is SRAC3, each curve drawn represents a corresponding level of different amounts of capital or land, depending on what factor is fixed. And so the scale of production is changing. The size of production is changing depending on that. And that's why you have different SRACs drawn throughout. Now, if you continue to draw the scale of production, you end up, for illustration purposes, you end up with, let's say, 10, or let's say 5 in my case, or 6. And so if you continue to do that, what you'll notice is, let's just write 4 there, 5, 6, and you see what's happening, okay? 7, right? You start to establish this envelope type shape. Now, before we move on to that, let's have a look at what happens, why is it overlapping, and what do you do if you're picking a quantity in the overlapping sector. Let's have a look at this quantity here. If you take this up, this quantity, you notice that it touches SRAC2 at a lower cost and SRAC1 at a higher cost. Clearly, you would choose, either is permissible, but you would choose to operate at C, not C1, because it's a lower cost. So wherever there is overlapping SRACs, the business will always choose the lowest corresponding level of cost in order to clearly profit maximize and benefit from low unit costs. Finally, if we do just sketch through curves that we had done previously, so SRAC, let's just call this, SRAC3, and then SRAC4, and finally SRAC5. Again, if you were to draw quantities throughout this, you'd notice that the quantities drawn, wherever it may be, would correspond to the lowest cost. So if we just pick another quantity here at Q and take this up here, okay, you would want to operate at this level of cost, C2, and not the higher level of cost on SRA C5, C3. So C3, you could also choose at that level of quantity, but you're not going to because it's a higher cost. And you can see how the envelope forms. Now, if we were to link these together, okay, what you'd notice is that you are going to draw another curve all the way through the lower ends of the existing SRAC curves. So essentially, you're trying to highlight this curve here, and then this bit, and then this bit, okay? And then this bit there. And it kind of looks like the LRAC curve, but not quite. And that's because there's only a few curves there. If, however, I was to draw many more SRACs to highlight the true scale of production that would occur in the real world for a firm, then you'll notice that the LRC, when drawn, is going to be much smoother okay, and it would look like a much straighter curve, LRAC. And that's how you link the curve together, guys, okay? The short run average cost of production have various different scales of production, even though one factor is fixed. And based on those different scales of production that a firm may choose, we then derive the long run average cost of production. And as you know, because the long run average cost of production, we've already said that all factors are variable, this means firms can choose to produce anywhere they wish within any scale of production they wish. So therefore, the LRAC curve drawn above represents that. And it's derived from the short run average cost curves and their different scales of production.